Hello everyone, welcome along to this quick webinar from Blu Sky Chartered Accountants covering some top hints and tips about getting investment ready. Okay, so let's just jump straight in. So for those of you who have no idea who I am, there's a little bit about me, including a fancy job title and some depressing football admissions. Yes, unfortunately, I'm a Sunderland fan. So I work for one of the UK's most progressive accountants firms, Blu Sky. Blu Sky are based in North Shields in a newly renovated 150-year-old pub, and we're accountants and business advisors that work with startups and scale-ups across the country. Our key philosophy is now and has always been person first and client second. So today I've got 20 minutes to blast through some top tips on how to get your finances investment ready. This video will cut up into two parts. This is part one, part two will be out later. So covering so much in such little time is a little daunting. It's a huge and varied subject, and so we try to trim it down to just some key tips that I've experienced during the last decade working with both KPMG and Blu Sky. Okay, first, to get us going, I'm going to run through some basic do's and don'ts of any financial management process. Then I want to check some characteristics of early stage investment rounds, before looking at some other sources of funding and finance, and finishing on why it's so important to have the right team. So let's get going and run through some general points on good financial management. Okay, so do be disciplined from day one and try and use cloud accounting where possible. A startup's finances need to be at the heart of its operations, and putting heads in sands will not help. And don't think that keeping a shoebox full of receipts is being financially responsible. In 2018, it's amazing how many people still think this is a responsible way to keep financial records. Do learn the key financial and dates and reporting needs of your company. You can't plan if you don't know what's around the corner. But don't outsource financial responsibility. Yes, having advisors is great, but startups shouldn't think that having a lawyer or an accountant means that they can wash their hands of their legal and financial responsibilities. Work closely with your advisors and take ownership of your duties as founders and directors. But do start with the end in mind. Founders need to understand what success looks like to them. Not everyone can be a unicorn, but that's totally fine. Chasing an unreachable goal can have serious negative effects on the health of both the company and the people working there. Okay, those were just some of the basics, but now I want to turn my focus to investment rounds and some of the key things to do and not to do at each stage. Okay, so for most people listening, a graph that looks something like this will be pretty familiar. If not, don't worry, I'm going to run through it in the next few minutes. The image shows some typical stages of investment from the idea stage through to the growth stages. And of course, we could extend this a lot further through the alphabet rounds and then onto exit. But this week, we're just talking about starting up and not scaling up, so I'm just focusing on the beginning. So now for the eagle-eyed among you, you'll have noticed that the last graph didn't have a typical seed round labelled. And I've done this deliberately. It's designed to showcase the importance of tax incentives to early stage funding in the UK. So for our purposes, seed is split into SEIS and EIS rounds, the tax drivers of early stage investment in UK businesses. So what are SEIS and EIS? Well, SEIS and EIS are government tax incentives designed to appeal to investors by lowering investor tax bills. Investors putting in the first 150k to a startup get a 50% tax reducer, and follow-on investors under EIS get a 30% reducer. These mechanisms are super successful at driving early stage investment in UK companies and significantly grease the wheels of early UK seed investment. At Blu Sky, we administer SEIS and EIS applications for raisers all over the UK, and we compile and apply for all tax benefits associated with raises conducted on the London-based Seeders crowdfunding platform. So let's look at the characteristics of the early rounds, focusing on pre-seed and seed stages that startups encounter typically in the first 24 months or so. We'll look at pre-seed first. So this is what a startup might look like financially at a pre-seed round. They're also likely to be pre-product and pre-launch and really be only a small ideas-focused team. So, when raising a pre-seed round, do ensure that you present a clear financial model that you understand. Startups should have a clear model of how their business will return value to the investor, but they should never present information that they themselves don't understand. If a third party help you to create your model, please ensure that you take the time to learn it before you present it to any would-be investors. And don't give away too much equity now. It might seem easy to give away a chunk of equity to kickstart your business, but giving away too much now will endanger the ability of the startup to grow in later stages. And definitely don't take too much from friends and family without the appropriate legals. It just gets messy. So let's move on to the SEIS round. So at this point, we're probably about 6 months down the line from the pre-seed investment, and here's what our startup's starting to look like. Notice the valuation pushing up and the founder's equity dropping. So what should the startup now consider? Well, do evaluate your likelihood of being SEIS or EIS approved. Experienced investors want the most certainty possible when it comes to their tax incentives. So please ensure that you've talked to an advisor about your SEIS or EIS status before promising anything. Even better, if the startup knows who their investor will be well in advance of the raise, an application for pre-approval, known as advanced assurance, can be made to HMRC. This helps give investors confidence and makes the startup much more investable. And don't underestimate the length of time it can take to raise finance. The energy and the time needed to raise finance is often huge, so don't underestimate the ups and downs along the way or the length of time it might take to get the deal over the line. Plan well in advance. So let's now finally look on to the latest stage seed investments, and we have the following picture of the startup's finances. We're now raising around $500,000, with the startup valued at about 3 times that of the SEIS round. And this cash should be pushing the startup towards its growth phase, and some traction in the marketplace should have been demonstrated. A few more do's and don'ts. Do know exactly why you need the cash and how you'll return value to investors. You're starting to now ask for serious money, and the move past SEIS means that the cash investment carries a much greater risk for investors. Where up until this point, investors may have been willing to take a punt. It's starting to get to the point where investors need a much clearer understanding of the chances of success and returns from their investment. So do ensure you investigate all sources of equity finance. That's venture capital, business angels, and crowdfunding. And don't restrict yourself to the local area. Look as far as you need to find the cash, and most importantly, the right investor to deliver value. And finally, and this is probably one of the most important points across all rounds, don't forget to monitor your cash runway. Thanks for listening. We'll come on to runway and some ways that startups can extend the runway in part 2 of this video. We'll be back soon. Thank you.